Yes, he is here, Mr. Mark Oshida, the regional head for Middle East and Africa, Cambridge Associates, and he will MC this session for 1 hour, and he will be inviting the speakers as well.
Your Excellencies, distinguished guests, ladies and gentlemen, good afternoon and a very warm welcome. As we're nearing the end of this conference, I know that attention spans are running low, but I can promise you that this will be a fast-paced session. If for no other reason, then we have 14 speakers to fit into just a 1-hour period. First, I express my gratitude to the Islamic Development Bank and specifically to the investment team for entrusting me with the role of moderating today's side event titled Sustainable Investing in ISDB Member Countries. In this event, we will be discussing the opportunities and challenges of mobilizing institutional investors and global asset managers for financing sustainable development in ISDB member countries. The event is under the patronage of His Excellency Dr. Muhammad Al Jasser, President of the Islamic Development Bank Group. Second, I would like to extend our deepest appreciation for the presence of their excellencies, Her Excellency Dr. Sri Mulyani, Minister of Finance from the Republic of Indonesia, His Excellency Mr. Sidi Keita, Minister of Finance and Economic Affairs of the Gambia, and His Excellency Dr. Sidi Welta, Director General of BADIA, the Arab Bank for Economic Development in Africa. Our event today is focused on sustainability, one of the two pillars underlining this year's annual meeting theme, Beyond Recovery, Resilience, and Sustainability. It comprises 3 sessions as follows. Session 1, chaired by Dr. Zamil Iqbal. Session 2, also chaired by Dr. Zamil Iqbal, Vice President Finance and CFO of ISDB. And Session 3, chaired by Mohammed Hedi Mejai, Director of the Investments and Treasury Department of ISDB. Without further ado, it is my honor and privilege to invite Dr. Zamil Iqbal to deliver his keynote remarks in the place of Dr. Mohammed Al Jasser.
Thank you, Mark. Bismillah Rahman Rahim. Excellency Dr. Sidi Mulyani, Excellency Brother Sidi Keita, Excellency Dr. Sidi Old Tah, our Honorable Board of Executive Directors, distinguished delegates, ladies and gentlemen, Assalamu alaikum wa rahmatullah. On behalf of His Excellency the President, I'm delighted to welcome you to this session. Unfortunately, His Excellency could not be here because the previous event was running late and unfortunately he had other commitments, so he asked me, he conveys his regrets but very warm welcome to everyone. So let me first start the thanking the Egyptian government for hosting in this beautiful city of peace. On behalf of the Islamic Development Bank, I want to express my appreciation to all of you for accepting our invitation to this high level panel. The topic to be discussed today is of utmost importance. While the pre-COVID 19 annual financing gap for SDGs was estimated at US dollar 2.5 trillion for developing countries, it increased by 50% in 2020, reaching a US dollar 3.7 trillion. The COVID 19 pandemic and its aftermath, the current geopolitical situation has significantly impacted all sectors of economy. In addition, the geopolitical issues, skyrocketing energy prices, and supply disruptions have profoundly affected the economic performance and prospects of emerging markets and developing economies, particularly all of our 57 member countries. Several member countries are not adequately equipped to face such challenges. Tackling such challenges and reducing SDGs financing gap would require shifting financing resources, including the private sector, towards sustainable development. It also requires ensuring greater alignment of all the investment chains with SDG needs. Institutional investors, in particular, can help, shifting only 3.7% of their assets towards sustainable activities in developing countries would be sufficient to fill the 3.7 trillion gap. Today's panel discussion discusses obstacles preventing the global asset managers and institutional investors from increasing their contribution to sustainable development in ISDB member states, despite the rise in sustainable investment and ESG agenda worldwide. The event will also discuss the catalyst role MDBs can play in the regulatory and financial and capital market development measures that need to be taken to mobilize institutional investors. In this particular context, I would like to appreciate the comments made by Dr. Sidi Milani during earlier meeting talking about the importance of development of soft infrastructure and developing the ecosystem to support, to mobilize capital markets and institutional investors. Excellencies, ladies and gentlemen, ISDB remains committed to supporting the SDGs and Sustainable Development Agenda in its member countries. ISDB targets funds with defined SDGs and ESG objectives through its Alternative Investment Funds program. They are managed by fund managers having the required capability to develop on such objectives. ISDB has several endowment funds with defined development objectives. These include Islamic Solidarity Fund for Development and for Poverty Alleviation, and the Work Fund for further economics and finance development. With more than $5 billion in assets under management, we, ISDB investment team, aims to achieve a diversified Sharia-compliant portfolio with return optimization in mind, albeit we take sustainability issues very seriously as our managers are required to show ESG credentials. I look forward to hearing the excellent perspectives that these world-leading figures, thinkers, asset managers, and institutional investors will share with us today. I hope to constructively, consecutively identify concrete actions that all relevant stakeholders can take to increase sustainable development financing by the global asset managers and institutional investors in the ISDB member countries. Thank you so much. Wa alaikum assalam.
Thank you so much, Dr. Iqbal. We would now like to proceed with the sessions by inviting the Excellencies, the panelists, to the floor. First, Her Excellency Dr. Sri Mulyani, His Excellency Sidi Keita, and His Excellency Dr. Sidi Weldta. Please join me here. The title of this first session is Increased Allocation by Investment Institutions Toward Climate Action and Sustainable Investing. Let's begin with Dr. Mulyani. Dr. Mulyani, in the current geopolitical environment, whether that be military action, whether that be climate agreements, the current environment is really impacting all countries. My question for you is, how is the current geopolitical environment impacting Indonesia, and what measures is your government taking to attract investors during this uncertain time?
Well, thank you very much for inviting me for this meeting, especially emphasizing the role of private sector. I think this is very important, especially when we are dealing with what you just mentioned, the current global and geopolitical environment. First, we all know that the environment in which we are all now have to deal with, especially as a policymaker, after 2 years of the pandemic, we are expecting a recovery, but because the recovery was uneven and continues still uneven, and then also creating a supply disruption, then we also see there is a new challenge of how the country can recover. Then before we really recover, there is a new crisis coming, like this geopolitical war in Ukraine, which is creating more spillover effect in terms of the food as well as the energy price. With that current condition, then the pressure on cost of money is becoming even more, cost of fund. Now, for a country who tried to develop as well as recover from the pandemic, especially after 2 years using all your fiscal space in order for you to be able to help the people from the COVID, to help the small medium enterprises, or in this case even to recover the economy, then you are dealing with a limited space on the fiscal side. Monetary side, because there is no pressure on the inflation, it's also creating another pressure on the monetary side. So the two very most important tools on the policy level at the macro level definitely facing a very severe constraint. In order for you to be able to recover, definitely you still need to have a capital. Now, with the interest rate increase in an advanced country, capital outflowing. So you have actually so many constraints with which you are now facing. Fiscal constraint, monetary constraint, and capital outflowing because of the interest rate in an advanced country. How we are going to make sure that the recovery is going to continue. And the second one is, of course, the role of private sector is going to be very important. First, if during the pandemic, the private sector can continue maintain their going concern, so there is no massive bankruptcy, then this time around, the private sector see with the recovery of economy in Indonesia, especially because we manage COVID relatively well. We also have a high level of the vaccination. So during this recovery process, the interruption from the COVID is already minimized. So that's good. The mobility of the people now already increased, and that's creating a domestic demand. In addition to that, we also see the commodity boom, in which for Indonesia, this is a very plus. So because we enjoy the coal, nickel, ferro, CPO, which is, I think, also creating additional source for a recovery for the Indonesia. The private sector development and investment climate that you mentioned is actually in the agenda of the government even before the pandemic. Indonesia has already put the business and investment climate is very important for us. That's why President Jokowi in this case enacted a lot of structural reform. The one which is very important is like, we call it the law in a job creation law. This is simplifying a lot of policy and regulation in starting doing business in Indonesia, especially by establishing what we call it one single submission. If you talk private sector, about private sector, there is a private sector which is small, medium enterprises, there is a big private sector, there is a domestic private sector, there is also a foreign private sector. What is most important for a country to be able to attract the private sector, if your own private sector, especially the small, medium enterprises, feel that there is no really significant or fundamental obstacle for you to start business, and that's why it's very important for you. So we passed this law of what we call it the job creation law, simplifying, debureaucratizing, simplifying the regulation, and providing what we call it one single submission. So even small, medium enterprises, they can easily register and then start their business. That's very important. The second one, sometimes, and especially when you talk about the private sector investing in a big infrastructure, or in this case on a sustainable finance like climate change, renewable energy, then you are dealing with the private sector who actually have the resources, but their risk appetite and familiarity with the risk of country like Indonesia still need to be bridged. They cannot like come, oh, okay, I come to Indonesia and immediately that they are going to be able to then start joining or investing in, especially on a big infrastructure project. So for Indonesia, we really identify and examine what is the risk appetite and what is the obstacle for this private sector to invest, especially in an infrastructure project. First, of course, in this case, certainty in terms of tariff is very important. There is also, in this case, the risk profile in Indonesia that is still, according to them, it's not yet familiar with. They can buy bonds, they can buy stock, but investing in terms of the equity is another thing. And that's why they feel comfortable if they don't have, if they have a local partner that they can trust. That's why for Indonesia, we created special mission vehicle like state-owned enterprises owned by Ministry of Finance, in which they become a reliable partner for this private sector who want to come to Indonesia and not yet sure, and they need to have a local partner that they can trust. This is, we have PTSMI, we even have what you call it the guarantee institution, which we established within the Ministry of Finance, a special mission vehicle. So this will provide all the menu for the private sector to be able to invest in Indonesia. If you are first very conservative on your risk profile, they prefer to have a lending instrument, then they just lend. If they have more appetite on equity financing, then we are going to then come up with equity financing. Even for Indonesia, in addition to PTSMI, we also established just recently Sovereign Wealth Fund. We call it the Indonesia Investment Authority. This is really dedicated to be equity financing, working with many of the global capital like ADIA, CPDF, CPDQ, CDPQ, which they are now putting money and investing together with our Sovereign Wealth Fund. Then you also have to look at the structure of the transaction. If the rate of return financially is not adequate, then the private sector said that if we want to invest, as long as the rate of return should pass a certain level that they are required. So that then, for example, toll road and other, then we can provide what we call it the availability payment. Start from the project preparation fund to the availability payment, or in this case, we even provide guarantee. I think these are all the menu that for a country as big as Indonesia, in which we actually provide quite a lot of opportunity for the investment, for the private sector, but for them to have the familiarity, then feel comfortable and confidence, then Indonesia have to provide with policy, regulation, institution, and even instrument, so that they are going to be then feel that, okay, I'm comfortable to invest in Indonesia. That's also need to be still elaborated based on the type of infrastructure. For example, like power sector, renewable energy is going to be different. On top of what I call it the general framework for renewable energy, for example, if it is like geothermal, hydro, solar, they are all going to have a different risk profile that need to be addressed. If you talk about toll road, then they are talking about the certainty of the revenue coming from the local currency revenue. All those things need to be addressed. So you cannot just talking in a very general term when you are dealing with the private sector.
Thank you so much. Thank you so much for giving us that very high-level glimpse of how Indonesia is handling it. I wish we had time to dive in more. Unfortunately, with the time constraints, we'll need to move on to the Gambia. And Dr. Iqbal just mentioned the funding gap to address the SDGs. My question for you, Mr. Sidi Keita, is sustainable investing among your government's priorities? And what is the government doing to close the SDGs funding gap?
Thank you very much. Yes, sustainable investment is the key priority in our investments as a government. We do this through our intervention in the priority sectors of the economy, particularly in the area of the electricity sector. We have invested in the electricity through solar and hydroelectric power. The solar will add to the energy mix as well as the hydroelectric power. The hydroelectric power is tapped from a regional project called OMVG, which is from a dam all the way in Guinea-Conakry. This energy mix will reduce the cost base and make the Gambia's energy very affordable to the population as the roadmap for the energy sector is improved. And the funding of the energy sector along these lines will also add to the climate-friendly nature. That is why the bundle of our energy mix has made Gambia able to be the only country that is eligible to be on track according to the Paris Green Climate Accord to meet their nationally determined contributions. In the area of, we also look at the sustainable SDG to expand our infrastructure. If you look at the road infrastructure in the Gambia, not much has been done in the last 50 years. And my government has constructed more than 600 kilometers of road in the last 5 years. This has a positive spillover effect over the entire ecosystem of the economy. We have sectors of the economy now that are developed thanks to this improved road network. And the road network is one area also that helps to reduce poverty in the sense that it gives farmers access to the market, and also the health outcomes are very favorable because the ambulances and the mobility for the health workers is easily accessible to the people. We will continue to invest in the development infrastructure of the country, and normally we want to reach this through the public-private partnership and it is the priority of my government to construct 1,200 kilometers of road in the next 5 years, because there is a huge infrastructure deficit gap. And meeting this gap, we will not be able to do it alone. We'll partner with private sector players through the PPP framework. This will bring private capital with the oversight and regulation of government to provide the development needs of the people where government resources are not deployed. This is very timely at this stage. As you know, we are just coming through the pandemic, and both the fiscal space is very limited as well as the monetary tightening. If you go fast, you'll jeopardize the growth that is very nascent at this stage. That's why we are relying on the public-private partnership to be able to deliver the infrastructure landscape that we want. We have a lot of spending needs in other sectors as well, through higher education, universities, health sector. All of these are areas that we want to do. But in addition to the public-private partnership, we also continue to leverage with the donor partners. The multilateral development financial institutions continue to be very strong partners in our development agenda, and they stand by us in our infrastructure and other social investments. Not only that, we are looking at innovative ways to leverage on our existing asset pool. We currently have a bridge that is constructed by the African Development Bank to the tune of $93 million, which is tolled, and we are looking forward to issuing an asset-backed security to be able to leverage the cash flows to be used to expand our infrastructure investment that we want to unleash in the next coming years. So this, in a way, how we are trying to attract financing to meet the SDG goals. And our development partners like BADIA, IDB, World Bank, ADB are very strong in our development agenda. Thank you.
Thank you. So we've heard, thank you. So we've heard about the situation in Indonesia and also the Gambia. Let's now turn to our last panelist for this session, Dr. Sidi Wilta, Director General at BADIA. Most people agree that we're in very turbulent times. The long-term impact of COVID on economies, rising inflation. What role can a regional DFI play to support its constituency during turbulent times such as these?
Thank you very much. It's clear that, as mentioned by the honorable ministers, Shri Mulyani and Minister Sidi Keita, we are in a very particular time today, and everybody was expecting that after COVID-19, the recovery will start. But unfortunately, with what is going on in the eastern part of Europe, and with the rising inflation rates and the disruption in the logistics value chain, it is clear that African countries are going to be suffering the most. As you know, during the COVID crisis, regional banks and particularly the Arab Coordination Group worked together to have this 10 billion initiative, which was adopted in May 2020. And that was focusing on two areas. One is helping countries to deal with health challenges, but also to take into consideration the need for supporting the real sector not to fail. And when talking about Africa, one should always bear in mind the fact that in Africa, 90% of the economic tissue is constituted by small and medium enterprise. And this feature is quite very important to tackle the issues of development, economic development in Africa. This is why during this very hard time and taking into consideration what is going on in the geopolitics, but also in the international logistic value chain, we are now working with many partners to establish a global coalition to support micro, small, and medium enterprises in Africa. And it is scheduled to sign the charter on the 14th of June in Abidjan, Côte d'Ivoire. What is the objective of this coalition is to provide a holistic approach to the problem faced by micro, small, and medium enterprises in Africa, particularly with regard to access to finance, access to market, but more importantly, capacity development. Because most of the financing lines provided to SMEs in Africa failed to reach the beneficiary because of the issue of guarantees, but also the issue of capacity development. The ability of SMEs in Africa to prepare a business plan and also to develop bankable projects. So this is why we are now working with all the partners, including Regional Development Bank, but also guarantee funds, insurance companies, philanthropia, academia, and also bringing also the private sector to support, and government, of course. Government are key because they are the regulator. So we will be signing the charter for this coalition on the 14th of June, and we do believe this can be really a very useful instrument for all development bank to support Africa, because 90% of the economic tissue in Africa is made by micro and small enterprise.
Thank you very much. Thank you. Please join me in a round of applause for our distinguished guests. I wish we had hours to really debate and to share ideas, but unfortunately, due to time, we need to move on to the second panel. So I'll excuse our guests and call for the second panel, Mr. Iqbal Khan, CEO of Fajr Capital, Ms. Marita Ali Jabana, Chief Risk Officer of Indonesia Investment Authority, the new sovereign wealth fund that was referenced, Mr. Arnaud Leclerc, partner at Lombard Odier, and Mr. Tabogo Naledi, MD of Old Mutual Group. And the topic of this session 2 is, should investors rebalance portfolios in line with rising inflation? Great. Thank you, everyone. As you all know, inflation is one of the hottest topics right now. And inflation is actually a threat to sustainability as well. Inflation increases the funding gap that was recently mentioned. Inflation increases the cost of living, and the impact is felt usually by those least equipped to handle it. And also, inflation makes budgeting very difficult. My first question is to Mr. Khan. From a macro perspective, what are the most attractive asset classes during these times of inflation?
Thank you very much, Mark. We are living in very interesting times, and the challenge of asset allocation can be best understood by the urgency which we face today because of high inflation, supply chain logistics, and many other reasons. For a long time, sustainability, climate change, impact investing, UNPRI principles were all about values. But today, there is an urgency because they are about value without the S. And they are about value because they are impacting the way we run our lives. If you looked at the Gulf countries, in the last 2 weeks, we have had sandstorms coming from Syria, Iraq, and that is a real impact on the way we live and the way we govern ourselves. The second point is this, that there is an alliance today between Islamic finance industry and ESG, Sustainable Development Goals, UNPRI principles, in what I call the alliance of goodness. So how do we allocate capital? It starts with good asset allocation. The asset allocations of the past will not work in the present. So we need to make sure that we protect our portfolios in line with what is happening in the marketplace. We need to make sure that we understand the principles of Mudaraba-based financial intermediation, where we can create thematic funds, whether it is SME, whether it is venture capital, or whether it is infrastructure, in order to create an impact sustainable based economy. Now, over a period of time, many institutions have focused on this theme of ESG-based fund management. And one of the biggest opportunities which exist is to create ethical, sustainable alpha for the large endowment funds, pension funds, Islamic finance industry. For if we do not create sustainable alpha, these institutions such as the Kaful companies, endowment funds, pension funds will not be able to grow and realize their value. So the sense of urgency which is today is much more important than it was ever before. I will leave to my colleague Dr. Arnold to talk about which sectors and segments to get into in the interest of time.
Great, thank you very much. So let's move over to Mr. Arnaud Leclerc. From a micro perspective, what are the attractive asset classes from your perspective?
Thank you so much for your invitation. Just for you, if you don't know, the Lombard Odier is a Swiss private bank founded in 1796. We're not so well known, but we are playing here for a long time, and we've been facing more than 40 crises since our foundation. But this is probably one of the very worst ones that we are facing today. Just the war, to rebound on what Iqbal was saying, is that the war is, we assume that we calculate it's going to be hitting global growth of at least 1%. Assuming also that the inflation in the US, our forecast would be 7%, 6.5 in Eurozone, 3.3 in China, and 1.8 in Japan. So we are talking of absolutely, we need to rethink what we are doing. Now, being very low, I would say, asset allocation and very pragmatic, we have a Sharia compliant mandates and also conventional ones, and we apply the same strategy for that. The sectors that we would favor, regional and sectors, let's say, the sectors we would favor today would be healthcare as a defensive, usually, sector against inflation, because of its earnings stability, which you all know, and quite importantly, because demand is not elastic. Okay, so demands will remain remaining in the healthcare, and today there are also affordable valuations in many of these companies. And these companies also have a strong, pricing power because of their subject. The second one, to be short, I promised, is materials, where we have to be careful, of course. You have the usual suspects, green metals, copper, platinum, and others, but we focus more actually on sustainability and, as a matter of fact, on paper, recycled, and aluminium. So that's also their sector that we're looking at very closely as well. And energy is still one of them, where, of course, the recycling and the new energies is absolutely key. There is, despite the crisis, and I'm very happy that Iqbal mentioned the ESG and the rethink we need to rethink all of that. ESG is absolutely key and is essential. But at Lombard Odier, we think that it's not just that today, because ESG is just about the how. ESG is to be, so to say, compliant with a certain processes and how you check and how things are done. But what do you effectively do in your company for climate change? What is the impact of your business in regard to the Paris Accord? Are you 2 degrees, 3 degrees, 4 degrees, or 1.5 degrees? This is much beyond ESG, and this is absolutely essential for Africa, as we just heard a moment ago. So that is the length that we use, to study that. In terms of regions, and I'll be quick, we have upgraded recently Chinese equities, because we believe that the COVID, outbreak is pretty much over. The regulatory crackdown that we have known as well is pretty much over as well, and the real estate debt overhang is not over yet, but has improved a lot. So this is something which could be a little bit unusual, and not just as classic, as a Swiss investor, to have the usual healthcare suspects, but also Chinese equity is something that we look at very seriously today.
Thank you very much. Perfect. So now we've heard from 2 asset managers. Let's actually turn now to the sovereign wealth side. Ms. Marita Ali Shabana, would you like to share with us how sovereign wealth funds can position themselves in the current geopolitical environment?
Thank you. Yes, we are now in a very uncertain time, and the pandemic is behind us, but the Ukraine and Russia war, of course, have made geopolitical tensions increasingly heightened. And the whole world, I think all the countries are feeling this tension.
Do you mind?
Sorry. Yeah, so I was just saying that the pandemic is behind us, but with the Ukraine-Russia war, of course, tensions are increasingly heightened, especially between the Western country blocks and then the Russia and China blocks. But the way that we see it with these uncertain times and how sovereign wealth funds should look at it, the Indonesian Investment Authority, which is the sovereign wealth fund of Indonesia, we actually look at it in a very simple way, and that is bringing it back to the basics. Sovereign wealth funds were created to create wealth for their nations and for their people. So we are going about the task of really getting to do that, and that is looking to get good investments into Indonesia with credible and good investors from a non-political stance. And that, I think, is also in line with the International Forum of Sovereign Wealth Funds Santiago Principles. So we're looking to be as non-political as possible. Indonesia itself is a member of the Association of Southeast Asian Nations, which has a principle of non-interference, so not aligning to any blocks. And from an investment point of view, Indonesia itself is actually a very attractive place for investment. It is the largest Muslim country. It has the world's 4th largest population, 270 million, a young population, average age is 30 years old. So it's a very attractive place. We have abundant resources, natural resources. So in this difficult time of rising commodity prices, actually Indonesia is in a good way because it benefits us. We have a very large domestic economy. And from an inflation point of view also, the inflation which is increasing, Indonesia's real interest rates at the moment are about plus 3.9%, which is one of the highest, especially among all the countries that now have negative interest rates. So there's many reasons to look at Indonesia to invest. From a climatic change point of view, we have vast amounts of tropical forests and seas that, if invested in properly and having the right development, would be able to make a significant contribution to climate change. And the Indonesian Investment Authority, of which I am representing here, is actually very new. We're only 1.5 years old. But this was established with very deliberate thinking on behalf of the government, and established in such a way so that it would be a long-term success with the right people in it, the right governance, the right framework. And I think we have also been increasingly getting feedback from investors. We have spoken to over 80 investors, discussed and starting to invest in there, in Indonesia, that they are very happy to have a partner, to be able, a solid partner and very professional people that are able to make them be able to take the opportunities to invest in Indonesia. Thank you.
Thank you. Now let's turn to our final panelist from Old Mutual. We have Mr. Tabogo Naledi, MD of Old Mutual Group. Potentially a very tricky question here. What should governments do to ensure increased allocation by investment institutions towards climate action and sustainable investing?
Okay. Thank you, Mark. As has been mentioned, I mean, the global asset management industry has got over $100 trillion US, projected to grow to about 140 trillion over the next 3 years. So it's a substantial capital. A lot of the solutions which governments have engaged with so far have primarily been the private market space. So if you look at blended finance solutions where governments have provided guarantees, governments have been early investors, early risk takers in projects. There's been a lot of that, and that's still to be encouraged, and I think there's a big role for governments to continue to play in terms of blended finance solutions. But I'd like to maybe focus more on the public market side, where if you look at that in excess of $100 trillion US of AUM, the bulk of assets sit in public markets. In fact, 70 to 80% of global assets are there. And so to the extent that governments could start shifting the behavior of institutional investors in directing capital more to investments that are speaking to the SDGs, investments that are speaking to the net zero agenda, I think that would be highly impactful. So how do we get there? I'm going to borrow from an old-fashioned saying, you cannot manage something you cannot measure. And so what is critical in the public market space really is for us to start measuring the kind of impacts that we see if we want to be directing capital flows into sustainable investments and into investments that are meeting environmental goals. Fortunately, there's been some movement around this, and what's quite exciting is some developments that happened last year. We are all aware of the International Financial Reporting Standards, IFRS, and the International Financial Accounting Standards Board sits under IFRS, and it's regulating pretty much how all of us are reporting our financials in a comparable, harmonized way globally. In December last year, IFRS launched the International Sustainability Standards Board, ISSB, which is similarly going to be looking at creating harmonized standards that are measuring the impact, and not just financial impact, but social impact, environmental impact of investments, requiring companies to be reporting not just, as I say, on their quarterly financials or biannual financials, but also on their impact on the environment, on social issues. And I would encourage governments to get involved in this conversation very soon. In fact, I think the papers went out for commentary at the end of March. And this is really around ensuring that what is being measured and looked at is appropriate, is relevant. In emerging markets, for example, I think the issues that are relevant to us will be different to issues in developed markets. And so we want to make sure that the standards that are being measured there are relevant for all our stakeholders. I think it's important that governments then also ensure that these are then implemented within their own jurisdictions and followed on with whatever interventions are necessary from a policy or a regulatory point of view. Governments legislate, companies act, they legislate, director behaviors, director requirements, director disclosure requirements, and that's a very powerful follow-on to ensure that there is measurement around impact. So if we can achieve that measurement, that transparency, that harmonization, I think the behavioral change will follow as investors start to look at, are we getting the kind of returns we're looking for? As pension funds give us mandates that speak to not just a financial return or a risk measurement, but also to some kind of impact. And bringing that into the public market space, I think could do amazing things in terms of closing that funding gap and really directing significant flow into sustainable investments and into climate action investments.
Thank you very much, Tabogo. Please join me in thanking our panelists. Let's now proceed with the third session, and let me invite to the floor Mr. Mohammed Hedi Majai, Director of Investments and Treasury Department of Islamic Development Bank, and who will chair this session. We have Mr. Ayman Soliman, CEO of the Sovereign Wealth Fund of Egypt, Mr. Ehman Kalkandelen, CEO of Franklin Templeton, Turkey, Mr. Sami Nafati, Managing Partner of InvestCorp and Aberdeen Standard Investments, and Mr. Sham Alvir, Partner at Forsan Group. The title of this session is The Role of Global Asset Fund Managers to Support MDB's Efforts to Address the Sustainability Development Goals. We have about 10 minutes remaining, so we'll need to be brief with our panelists. And let us start with Mr. Ayman Soliman from the Sovereign Wealth Fund of Egypt. The question is, what does the current geopolitical and economic environment mean for global asset managers' portfolios in ISDB member countries?
Well, thank you, Mark. I think there are two sides to this equation. There's on the buy side and the sell side. What's unique about the Sovereign Fund of Egypt, and similar to a lot of sovereign funds coming out of emerging markets, we are a minority buy-side partner, but we're also mainly on the sell side to crowd in partners to our investment opportunities. And with that hat on, we see a lot of opportunities that emerge for our part. So North Africa, the rest of Africa can become a reshoring destination for the disruption of logistics and supply chains. We're seeing a reshuffle of partnerships. And the element of sustainability around all of those partnerships, sustainability cannot be achieved in isolation. Sustainability is actually financial sustainability, economic sustainability comes with symbiosis. So we are a resource-rich market, we are a renewable resource-rich economy, yet we are capital-strapped, but we have abundance of those resources. How can we develop those resources? And the bankability of those projects relies on the partners that will be the off-takers of those resources. And we have a massive Renewable to X program that we recently launched, taking our renewable resources downstream towards either a green industrial real economy product, agri or fertilizer or steel or aluminum, or green fuel, and then the logistics part of the Suez Canal is something that we're going to green. So those are investable opportunities that we are rediscovering, and now the appetite with the disruption that is happening globally is actually crowding in a lot of appetite towards our markets and towards our part of the world to see us in that light. So this is how we see that opportunity, and we invest behind that as well in partnership. And this is a mix of all the previous dialogues we had with the fellow panelists where they were talking about the role of sovereign funds to really try and fill that gap between de-risking, trying to partner, be on the buy side, be on the partnership side, and also try and articulate the ESG commoditized mainstream partnership model that everyone takes for granted. And I think what's adding to that trend of saying ESG is becoming commoditized is no longer we should take ESG for granted. The next thing we add to that formula is, yes, it's ESG, but ESG that creates sustainability, that is investing towards sustainability, and this has to be baked into our investment propositions right across the board.
Thank you very much. Let's move on to Irman from Franklin Templeton. What industries and sectors are most attractive for asset managers in ISDB member countries?
Does it work? Okay, thanks for the opportunity. I'm working for Franklin for 16 years. I mean, Franklin Templeton has been investing in ISDB countries since 1990s. We have seen a lot of crises, like most of my colleagues here. What is attractive here now in this current junction is one of the terms that we actually use a lot, and we also launch products as Climate Alpha, especially on the climate change side. Who is investing in now in these countries into industries that will be very valuable going forward, especially on the climate mitigation and adaptation side, mainly on the energy transition and transformation, anything about the electric batteries, mining infrastructure, the equipment delivery companies will be the ones that invest in them today will benefit majorly, because the climate problem is a global problem. It doesn't matter where the money comes from. Any issues in Turkey or Egypt, wherever, if that carbon has to be captured, it has to be captured. So the money will definitely flow in those industries on the climate side. The next thing we see, the big thing is technology. Technology is actually in multiple ways is changing this society's work. One is as an enabler. It is countries of, many ISDB countries are actually exporter of commodities. But now, as, first, this technology companies attract a lot of capital, especially from international investors like us. So it gives a chance to a lot of underprivileged parts of the societies to actually access to capital, which was a privilege to mainly, the big business people in the past in these countries. I mean, you can be a couple of university students in a dormitory room, but then suddenly you have a software company or a gaming company or a SaaS company can sell your products hundreds of countries globally without just changing even your country. So technology also enabler of this for a lot of parts of the societies. You can create a educational tech company or health tech company, can enable remote working or access to healthcare by the other parts of the society. So in multiple ways, technology will be very important in the ISDB countries, and we believe in that as a firm. Aside from that, healthcare is very important, especially to realize some of these SDGs. We continue to invest that part as well. Services, these countries need quality services in multiple ways, and service companies are scalable in these countries because most of these companies grow very fast. Industries are actually becoming much more important and not getting enough attention now, but the world is polarizing now. The supply chain is changing again. The proximity is becoming important. The countries are close to Europe and US and can adapt to much faster responding to their clients in those countries, attract a lot of capital, which is actually not the case now, but they're actually making a lot of money now in most of the ISDB countries. If you look at the companies who are good in industrials, are actually making very good returns. And education, I think I don't need to mean, because that's very important in these countries for the overall improvement of those societies. 3 minutes, 30 seconds. I'm done.
Thank you very much, Irman. Now moving on, Sami. What role, so similar question, what role can global asset managers play in addressing the SDGs?
Thank you for the invitation. Probably a personal note, I think starts by personal conviction. I think as a human, as a father, as a mother, you look at the world and very quickly you would draw a conclusion that it's getting harder and harder to live in. It's harder and harder to explain that to your kids, whether it's the food price or why other kids don't get to go to school. I think that's an important factor. Now moving on to an institutional level, I think asset managers are there to cater for their investors. And we hear more and more investors, whether it's private offices or institutional investors, pension funds and sovereign wealth funds, being more and more vocal about where their money needs to be directed and should be directed. So that kind of sprung asset managers to cater for that. Asset managers are in a unique position to create change. They invest in private markets, they invest in public markets, and they have a very strong reach. And it starts by mapping out your own portfolio and looking at what the companies that you own or part own are doing on the SDG side, how you measure that, and also how you create strategies to invest in impactful, SDG impactful in industries and sectors. One of them is infrastructure, which is my own remit in this region. And the countries where we invest, where I invest, are IDB's member countries. So you invest more in healthcare, you invest more in education, you invest more in transportation, and that has an immediate impact. But also when you look at gender equality, infrastructure has a ripple effect. We deal with construction companies, we deal with the financial services, we deal with legal services. And we very simply, when we deal with all these institutions, these various sectors, we tell them, if you do not respect the principles we believe in, you will not work with us. And infrastructure deals with tens of billions of investment, so that has a major impact. Having said that, we all have to remember, and I've been hearing very encouraging thoughts from world leaders over the last few months. It's very, very easy to get entangled in the narrative and to run ahead of ourselves. We still need to be able to cater to the world and the development of the world today. What we are embarking on is a transformation. We shouldn't ostracize and cast away entire industries like the oil industry or the mining industry completely. You can't ask the countries of the region to produce more oil where you tell them you cannot finance that. You can't desire and want more iPhones and technology while you're ostracizing the entire mining industry. So the world has to be consistent with its own self. And remember, this is a transformation that we need to finance, that we need to invest in. If we are investing in decarbonization or sulfur recovery with a national oil company of the region, that has a good impact. 3 minutes, I think I told you.
Thank you, Sami. And a final panelist, Mr. Sham Elvir from Forsan. To what extent can global asset managers achieve profit and contribute to sustainable investment simultaneously in ISDB member countries?
Thank you. Bismillah ar-Rahman ar-Rahim. I'm in an unenviable position. I'm the last to speak, and I have a captive audience, and everyone would like to leave, so brevity will help, I'm sure. I'll start with a quick example, because you just mentioned education. We manage a private equity fund, and we're fortunate enough to have ISDB as an anchor investor. And during the COVID crisis, like many schools, they went online. Parents didn't want to pay the full fees. They pulled their kids stayed home. People were learning online, and people said, we don't want to pay these expensive fees. Government in Jordan introduced a program and said, we'll help you with defraying some of the employee costs. And if we do that, you have the opportunity to lower salaries by up to 25%. What do? Do you lower salaries by 25%? Salaries constitute about 70% of all your costs. So what do? Do you lower people's down to from $300 to $200? How do you manage that balance? There's a return issue at stake, and then there are people's lives. And it's a pandemic that happens once every 100 years. We took the decision that we will not lower. It's legal, you can do it. And many others did it, but we took the decision that we would not lower salaries by 25% for the year and a half. We believe that that was the right decision long term, and we believe that when we look at ourselves as a fund and when we look at companies, that the job of a company is to not be myopic and focus on short-term shareholder growth or profits. The view is you're an ethical enterprise, and your focus should be on creating value, but that's sustainable and long-term. And the view should be that maybe I was discussing this with one of my colleagues, did we take a hit that year? Do you use that term that you took a financial hit? Or is that term wrong? That you say you did not take a hit, you invested in your people. And that's the way to approach it. And I have to say, we thought about it for a year and a half that we took a hit. Now we're seeing things on the up and up, so we weren't, we had some tough times thinking about it. So balancing impact and balancing financial returns isn't always easy, but I think if you continue to think of the corporation as focused, not being myopic, focused on these long-term views, that works well. The other view is that sometimes when you work in countries like the countries we target, the Levant, North Africa, that sometimes people look at the SDGs or ESGs as a luxury. That, employ people, create profits, pay taxes. In Arabic we call it taraf. It's just too much of a luxury when you're a developing country to focus on these global goals that maybe don't really apply. And again, I think the school was an example where we thought standing by people was the right choice. But you mentioned gender earlier. We think gender is another issue that's important. In countries, some of the countries where we invest in female participation in the workforce is 15%. If we can have 30, 40% female employees, we think the impact here is on steroids, it's plus. That we think is directly related to investments made by institutions like ISDB. So we think that actually long-term also creates value. But you have to kind of move away from thinking in a myopic fashion. You have to continue to think long-term, which is not easy. Private equity funds sometimes have that luxury. You can think 5 years, 7 years out. You don't have to think every quarter what's going on. But I think even the whole narrative is changing, even in public markets, that people are saying, it's a debate about activist investors versus long-term value. And people who wear the activist investor hat say we add a lot of value, we're not short-term investors. And corporations will say maybe, maybe not. We think we need to look 2-3 years down the road. Let me just give one more example and I'll let everyone call it a day. There's a transfer of wealth going on globally right now, right? There's almost 30 trillion just in the US alone that's transferring from generation to generation. And millennials now are thinking about issues that people 20 years ago maybe were not thinking about. That's conventional wisdom. But I would argue that 20 years ago, people were looking at tobacco companies and saying those are bad companies. Let's not invest in them. So I don't think this trend is as new as we always think about it. I think this trend has been there for a while. 20 years ago, people tried to divest from tobacco companies. Today, people are looking at climate. But as you just said earlier, I think, Sami, it's important that we don't ostracize people in an oil and gas sector, for example. And this, as to conclude, it's sometimes companies and big investors like ISDB are driving an agenda, and it's important. But if we really want to attain the ultimate goal of impact, the onus has to be placed on the legislature. The legislature at some point has to say, this is legal, this is illegal. Otherwise, we're using our values, right? We're saying we don't want to invest in a cafe that serves hubbly bubbly or shisha or argila if we're against smoking. But it's legal and it makes a lot of money. You can make that decision, right? But if you really want to drive the impact that you want, then it has to come from the legislature. And that becomes a much more difficult discussion because it's a policy question. But at least as private sector actors, I think we're all trying to do our part. And I think I'll stop here. Thank you so much.
Thank you very much, Sham. Now, just to conclude this session, as well as this event, let's turn to Mr. Hadi Majai, who is chairing this session, as well as head of investments at Islamic Development Bank. The question for you in your closing remarks, as head of investments and treasury, what are you trying to achieve in engaging with global asset managers and institutional investors in an MDB context?
Thank you, Mark, and thanks to all the panelists for the time and the interesting discussion. Of course, Islamic Development Bank is a multilateral institution. On the investment side and treasury, with my team, we
a little closer.
Yeah. With my team, we manage about $20 billion US. It's divided into pool of funds, the endowment and trust funds, and this is a sizable chunk that we invest, basically looking into two dimensions, return and diversification. So our strategy for this is very much capital preservation, as well as diversification in terms of asset classes, as well as strategies, whether passive or active. Of course, the objective of this is to maximize the return so that we can use this for our developmental mandate for these trust funds as defined by the trustees. On the capital side, we invest, of course, with the return objective, but also with the intention to diversify our income stream, because as a multilateral, the bulk of our income comes still from our financing portfolio, whether that is sovereign or PPP. So when we invest our capital, a portion of it is as part of our liquidity management, so it's very much short term. For the part that is medium to long term, we invested through a limited partnership program. And for this, we are very much selective, basically, when we assess investment into this type of funds. We select the funds, of course, on the basis of the mandate of the fund. I mean, it has to be in line and complementary to our strategy in terms of core sectors. Also, we look at the team. We co-invest a lot with sovereign wealth funds and multilateral institutions. And we do as well an assessment when it comes to ESG. And this is very much present in our due diligence when we look at funds, so that we can basically achieve multiple targets when we invest. So far, we have an active portfolio, about 25 funds. So we are co-investors with the gentleman here on my left, whether in Forsan or with FT or with Investcorp Aberdeen. So very much we diversify in terms of region. So usually the funds in which we invest, they cover more or less our constituency, as well as the sectors that we are targeting, whether these infrastructure or climate-oriented or transformation. So this is really, in a nutshell, what we do as a multilateral. To conclude, we have heard basically for the first session, I mean, Their Excellencies, the ministers, focusing on the absorption and their readiness and the opportunities that are there in terms of investing to meet basically and achieve the SDGs. So the opportunity is there from a demand side. We have listened in session 2 and 3 from different asset managers, basically whether these are private equity asset managers or multi-asset global asset managers. So there is interest in ESG and as well as in Islamic finance. We have listened as well from sovereign wealth funds, I mean, and definitely with their strategies in their home countries or diversification. So I think all the stakeholders, I think, came really and converged towards the importance of ESGs and supporting the Sustainable Development Goals, which is basically a core mandate and aspiration of IDB. Thank you, Mark, once again for your time. Thanks.
Thank you, and thank you, everyone. Thank you, everyone, for your attendance. I think we're just 1 or 2 minutes past the half hour, so thank you, everyone, for keeping it brief and for discussing this very important topic. There's pros and cons of involving 14 people in 1 hour. The con is the depth that we're able to get into without the dialogue and debate. But the benefit is we've never had probably so many people in just 1 hour so influential in capital markets, government, asset management, involved to discuss this very topic. So thank you very much.
Thank you very much to all the panelists. Thank you. And now we are moving to our last session for PSF 2022. We would like to keep this session engaging and interesting, and therefore I want to invite